In July 2026, one of the oldest, most boring, most bulletproof companies in America lost $67 billion in a single day. Not over a year, not over a quarter. In one trading session, the company was IBM. The stock fell 25%, the worst single day in its 115-year history. Worse than Black Monday in 1987 when IBM dropped 23. Worse than the dot-com crash, worse than 2008. And here's the part that should stop you. The thing that triggered a $67 billion wipeout was a revenue miss of about $660 million. IBM came up short by $660 million, and the market erased 100 times that. Now, a crash that size usually means a competitor, a scandal, a fraud, a product that blew up. This was none of those. IBM was killed by the one technology it had spent the entire last decade telling the world it was going to master: artificial intelligence. Now you might think this is just another dinosaur getting run over by the future. The old mainframe company missed the AI wave the market finally noticed. End of story. And on the surface, sure. But that's not what happened here, because IBM didn't miss AI. IBM bet the company on it. For years, its entire pitch to corporate America was, let us guide you safely through the AI revolution. And the AI revolution is the exact thing that just gutted its quarter. So how does a 115-year-old company that already survived death once, that has reinvented itself more times than almost any firm alive, get blindsided by the very gold rush it claimed to be leading? To see it, you have to understand what IBM actually sells, because it was never really computers. For most of the last century, IBM sold one thing: trust. Back in 1964, IBM launched the System Truck 360 mainframe, and it quietly became the backbone of the modern world. Not the flashy part, the backbone. When you swipe your card, book a flight, or file your taxes, there's a very good chance the transaction still runs somewhere deep down on an IBM mainframe. Banks, airlines, governments, insurers, the institutions that absolutely cannot go down, run on this stuff. That's where the most famous phrase in corporate tech came from. Nobody ever got fired for buying IBM. It didn't matter if IBM was the cheapest or the most cutting edge. It was the safe choice. And it turns out that selling safety to people who are terrified of failure is an incredible business. But safety alone isn't a growth story, and IBM learned that the hard way. In 1993, the company posted a loss of roughly $8 billion, at the time, the largest annual loss in American corporate history. Everyone assumed the giant was finished. Instead, IBM did the thing it does better than almost anyone. It pivoted. It stopped being a company that sold boxes and became a company that sold advice. Consultants who would walk in and run your entire technology backbone for you. And over the next 30 years, it kept reinventing that same core idea. It sold off its PC business. It bought Red Hat for $34 billion. It spun off its old infrastructure arm as a separate company called Canary. And most recently, under CEO Krishna, it repositioned the whole company around two words: hybrid cloud and AI. That was the plan. IBM would be the trusted grown-up who guided nervous corporations safely into the age of AI. Not the company building the flashy chatbots, the company you hired to make sense of them. Selling the picks and shovels for the enterprise gold rush, it was a good plan. It just ran into one problem nobody put in the spreadsheet. Quick pause. This is Vested Lens. Every episode, we follow the incentive, the hidden stake behind why business and tech really do what they do. If that's your thing, subscribe. Now, back to IBM. To understand what happened to IBM, you have to follow the money down to one small, deeply unglamorous component: memory. The chips that hold data while a computer is thinking. Here's the chain. To build AI, you need enormous amounts of a special kind of memory called HBM, high bandwidth memory. The stuff stacked right next to the GPUs in every AI data center. It's spectacularly profitable to make, with margins several times fatter than the ordinary memory that goes in laptops, phones, and servers. So when the AI boom hit, every memory manufacturer on Earth did the rational thing and swung their factories toward it. Now here's the trap. This AI memory and ordinary memory are cut from the same silicon wafers. Every wafer that goes to AI is a wafer that doesn't go to everything else, and it's a glutton. Producing a single bit of it eats roughly 300% more factory capacity than a standard chip. So as AI demand exploded, the supply of regular memory didn't just tighten, it got starved. The result was a shortage unlike anything the industry had seen in years. Memory prices jumped roughly 90% in the first quarter of 2026 alone. Some server memory kits didn't just rise, they doubled, tripled, quadrupled, and they kept climbing into the summer. If you tried to buy server memory in mid-2026, you were paying multiples of last year's price, if you could get it at all. Lead times on some parts blew past 40 weeks. Now put yourself in the shoes of IBM's customer. You're a big bank or a retailer or an insurer. You've got a fixed technology budget for the quarter. You can see memory prices spiking and supply drying up in real time. What do? You rush. You grab the physical hardware, the servers, the storage, the memory now before it gets more expensive or vanishes entirely. And that money has to come from somewhere. So in the final weeks of June 2026, IBM's customers quietly raided the rest of their budgets to pay for it. The budgets that would have gone to new software licenses, to consulting engagements, to mainframe upgrades, all of it got pushed to later so they could buy AI hardware now, which is precisely where IBM makes its money. When the preliminary numbers came out, revenue landed at $17.2 billion, against the roughly 17.9 Wall Street expected. Operating earnings came in at $2.93 a share, about 8 cents light. Infrastructure, the mainframe business, fell about 7%. Consulting was flat. Software grew 5%, but nowhere near enough to fill the hole. And a wave of big deals that were supposed to close in June simply didn't. Then Krishna did something CEOs almost never do. He filed a blunt letter with regulators and admitted it in writing. What played out, he wrote, was worse than our expectations. We did not adapt and move quickly enough. These are not excuses, they are realities. And there is the irony that makes this one of the great business stories of the year. IBM spent a decade telling corporate America it would sell them the tools to survive the AI revolution. It branded itself the safe guide through the storm. And instead, the AI revolution reached straight into its customers' wallets, pulled out the exact dollars earmarked for IBM, and handed them to Nvidia. The company that promised to help everyone manage AI couldn't protect its own quarter from it. But here's the question that should actually worry you. Why did the market erase $67 billion, 100 times the size of the miss over one soft quarter? Because of what IBM is. IBM is not a hype stock. It's not a speculative AI moonshot trading on a dream. It's the boring, diversified, 100-year-old incumbent, the single most conservative name in enterprise tech. And if the AI gold rush can reach in and gut IBM's earnings, it can reach anyone standing downstream of it. And it did. The same day, IBM didn't fall alone. ServiceNow dropped about 8%. Microsoft slid 3%. Salesforce, Accenture, Workday, Cognizant all fell in sympathy on a day when nothing bad had happened to them. The market wasn't pricing one company's bad quarter, it was pricing a pattern. The New York Times' deal book asked whether IBM was the canary in the tech coal mine. The Financial Times called the plunge a warning to the IT sector, and the economist Steve Hanke pointed at something bigger, what he calls a dual bubble. We really have two bubbles in markets, Hanke says. The first is the one everyone already talks about, a valuation bubble. Prices racing ahead of earnings. That one's old news. But the second is rarer and more dangerous. It's an earnings bubble. The $1 trillion flooding into AI infrastructure is inflating the reported profits of a handful of chip and hardware companies, while quietly hollowing out the earnings of everyone whose budget got raided to pay for them. IBM is simply the first big, boring, essential company to show that second half out loud. Its stock didn't just fall on a bad quarter, it fell because it proved in real numbers that the AI spending frenzy isn't only lifting some companies, it's actively starving others. And that's the real lesson here, the one that goes way beyond IBM. Every gold rush has two kinds of companies, the ones selling shovels and the ones who get trampled buying them. For 30 years, the safest bet in all of business was nobody ever got fired for buying IBM. What July 2026 showed is that in a gold rush, this violent, even the safe, boring, essential companies aren't safe. Because when everyone pours everything into the one shiny thing, the money to buy anything else simply disappears. IBM didn't get killed by a competitor, it got killed by a budget line. And if Hanke and the FT are right, it won't be the last.